there'll come a point, and this can be triggered at any point in time. We're at a point of crisis now. We're long-term insolvent. We've got a budget a deficit that's running out of control. Got to borrow a lot of money next year. All sorts of conflicts in Congress.
What do we do? What do we do, John?
What happens is right now we're dependent on foreign capital.
Chinese?
If foreign investors flee the dollar, which they will do here if they're convinced that the U.S. is long-term insolvent or it's not going to be able to handle its finances down the road, which increasingly is the issue. You'll see massive selling of the dollar, flight from the dollar, and that in turn will spike inflation here. It'll boost oil prices, and you'll see a big rally in gold as people seek safety outside of the dollar.
Loading the American Confidant intro.
We have $15 billion in gold in our treasury. We don't own an ounce.
And one of the problems is we don't have the gold. Other places have the gold.
It's called the American dream because you have to be asleep to believe it.
On today's show, special guest appearance by John Williams of ShadowStats.com. ShadowStats.com is a website that analyzes and offers alternatives to government economic statistics for the United States. ShadowStats primarily focuses on inflation, but also keeps track of the money supply, unemployment, and GDP by utilizing methodologies abandoned by previous administrations from the Clinton era to the Great Depression. The site is authored by consulting economist Walter J. Williams, who holds a BA in economics and an MBA from Dartmouth College. He is popularly known as John Williams, and here's the American Confidant.
And welcome to the American Confidant, ladies and gentlemen.
Confidant.
Happy Monday. The Confidant is ready to go.
The American Confidant.
I'm Jim LaFave. I'm here with Cash and Anthony, and we're here interviewing John Williams. John, it's a pleasure to see you. John, of course, is the leader of ShadowStats.com, the website bringing alternative information, the real news, not fake news, on the economy to the American people. John, welcome to the show. How are you today, sir?
Fine, thanks, Jim. Thank you for having me.
I wanted to ask you really quick, John. I've listened to interviews in the past, and it's obvious that you're reporting from a consumer-driven society angle, that the government is misrepresenting figures to get us to buy stuff. Now, what motivated you to get started in this, John?
Well, I had developed a unique set of models for predicting the economy, and that's where I started my business some 40 plus years ago. And as time went along, I found that the numbers were changing, and in fact that the government was shifting its methodologies in the way it reported its numbers, and usually it's pretty open about it. But the changes that they made over time generally were aimed at giving them politically better numbers, or numbers that would cost them less money in terms of adjustments they had to make to, let's say, cost of living adjustments.
What's the rough time that started, Security. John? When roughly did that commence, would you say, when you got into it?
I'm sorry, say that again?
What time was that? When was that, when you noticed this beginning, when you made that switch?
Back in the 1980s, you started to see some changes in the way they measured inflation. That got very strong in the 90s. They redefined the unemployment numbers in 1994 at the time of NAFTA, with the effect of making the unemployment picture made it look a lot better. And as the inflation numbers changed over time and were brought down by new methodologies, that also boosted economic reporting, such as the gross domestic product, because the headline economic numbers that you see are adjusted for inflation. And if you use too low a rate of inflation in adjusting, that overstates the headline economic growth net of inflation.
Okay, that brings us to the top five. In your opinion, John, we have the government misrepresenting figures. We have them starting in the 80s and the 90s. We can see then an incredible expansion in the U.S. Treasury market and the debt market. Would you give me the top three indicators that you see the government misrepresents to keep us spending our money?
Well, there are three that I focus on. Number one is the inflation number, because that directly impacts how people live. that as a subsidiary effect also affects a lot of the economic statistics like the GDP. The third area is the unemployment, and that again was redefined in 1994 around the time of NAFTA. So those were the 1994 shift was aimed at eliminating some of the political issues that would arise out of NAFTA and a lot of people losing jobs offshore, which happened.
Wow. Can you tell me what were the changes made in 1994 to that reporting specifically?
Well, this is in with the employment numbers. They've always had the headline number, which is people are out actively looking for work, they're unemployed. They have to be actively looking for work. The way they define it these days, you have to have actually looked for work in the last month and been willing and able to take a job. But there are a lot of people at times who find that they just can't find a job. There are no jobs to be had, so they stop looking. And they've been counted in the past as discouraged workers. And the way it used to be is that coming into 1994, if you've given up looking for work but wanted a job, if you've given up looking for work because you're convinced there are no jobs available, you'd be counted as a discouraged worker, and they'd carry you on the rolls and they'd survey you. And
so you would still be in the unemployed number. You would still be counted as unemployed.
These people were unemployed.
Right.
I'm sorry?
You would still be counted as unemployed before 1994 as a discouraged worker.
Well, you were counted. You were counted in a different category.
Okay.
Which was called as a discouraged worker. It's a broader measure.
Okay.
You still have the headline numbers that people are out actively looking for a job within the month. But if there were no jobs available and people just stopped looking, but they were interested, I mean, they might occasionally look for a job, or they'd keep an eye open on the market. Mm-hmm. But if they'd been out there and they just couldn't find a job and they were satisfied that there were no jobs available at that time, they were still counted, and they were counted as a discouraged worker. And you see a broader measure.
Right.
Well, they when they redefined this in '94, they changed everything except the headline number, and even there were even some changes there. But what they did was they decided to count discouraged workers only for 1 year. If they were discouraged after 1 year, they were just dropped from the rolls.
Okay.
And where that's significant is that the people who'd be displaced, let's say by a factory shutting down because it was moving offshore, they would have been counted in the older broad measures, but they're not. They're not today. The broad measure today is they call it U6, and it includes the headline one they call U3, but the U6, which let's say the headline's around 3.6%. The U6 is up over 7%. But had they counted the discouraged worker, which is included in the U6 number, the way they did before 1994, you'd find that unemployment was is up around 20%. Looking at the broader measure.
Can you tell me? Can you
and
give?
That's a significant difference.
Can you give our numbers or our listeners that number again? The real unemployment number, John.
What I'm saying is it's about 20%.
About 20%. So right.
About 20% as the way it would have been counted before 1994, and that's the broad unemployment measure. And there's some direct evidence of that in other numbers they publish. They put out some measures of employment stress, which is it's the ratio of the employed to the population, or the ratio of the labor force.
Good Lord. Good Lord.
The labor force to the population,
John,
the participation rate.
Can I cut in here for a moment? Have you ever been harassed by the government? I mean, look, this is incendiary what you're saying. I mean, if we're to depend on the government for accurate figures, right? And we're in the age of fake news now. I mean, I hear the president talking about fake news. I hear all this. And yet, here we are. We're in the thick of fake news since 1994 with this government reporting. Now, have you ever been harassed by anyone who for disclosing this material?
Not by the government. Occasionally, they'll have comments that would tend to counter some stuff I might have when it gets some press, but nothing's ever been directed at me directly that I know of. I have had some. I've certainly had some comments out of the private sector, and how much of that might be tied to the government or people who have a vested interest in this. The thing is that you have whether it's the unemployment rate, which is largely a political issue. The average guy knows whether or not he's employed or unemployed. He's not fooled by it. The average person knows where the economy is.
Mm-hmm.
If Main Street USA has a pretty good sense of it, irrespective of what the government publishes, and the average person has a pretty good sense as to where inflation is. Mm-hmm. I talk to a lot of people, and most people I talk with will say, they underestimate inflation, and that is the one area that they've been very open about, discussed openly before Congress as to what they were doing, and they did it, and everybody sat on their hands, and nobody. I mean, I raised a lot of stink over it, but very few people did. Again, Congress was behind this.
John, how much time do we have, really? I mean, how much real time do we have here? We've got, right now, the big issue now is if the government can't function unless they expand the debt, correct?
Yeah, well, that's where things will eventually fall apart. If you can keep everyone happy and buying bonds and not dumping the dollar, you can keep the system reasonably stable. The problem is the government is effectively bankrupt, and in fact, it is long-term bankrupt. There's no question of that. The government puts out financial statements prepared by the GAO that shows the financial condition of the country using generally accepted accounting principles, and where they put in net present value, where they calculate the total cost in today's money, how much money you need in hand today to handle, let's say, Social Security and Medicare. Mm-hmm. And what it shows is that right now there's a deficit in terms of cash you have to have in hand today of close to $100 trillion. We have $20 trillion in outstanding treasury bonds. But if you wanted to be solvent going forward, the government needs $100 trillion in cash in hand today, and it could cover everything then going into the future with its planned taxes and everything just be fine and dandy. But there's no chance it can possibly come up with that.
Would you see a scenario? Would you see a scenario, John, where the United States of America and the people repudiate the debt, where they put we renege on the treasuries? Would that be possible?
Well, there goes one of two ways. Either something like that, or probably more likely something along the lines that Alan Greenspan suggested back when the Standard & Poor's downgraded the U.S. Treasuries in 2009. They weren't concerned about the long term there. The people in Congress were making noise about, maybe we'll force a default here and trying to get people's attention and getting things funded here. So they had to downgrade it. But Greenspan, who was no longer a Fed chairman at the time, came out and said, well, the risk of the U.S. Defaulting on its debt is nonsense. It'll never happen because everything that the U.S. owes is in dollars, and we can print as many dollars as we want.
Wow.
And that's what we've been seeing increasingly, and it's a slow, painful death. I think it's if you put a frog in a pan of water, it'll sit there, and you turn the heat on, it'll stay there till it boils to death. Well, here that's our circumstance. Eventually, they'll print the money that they don't have, and that becomes inflationary, hyperinflationary, and the dollar becomes worthless.
John, quick question: can they print the money they don't have? Do they have to sell that bill to someone, or can they just create it in there? Does somebody have to buy U.S. Treasury?
That's what I'm getting to, because they have to. people have to be willing to still hold the dollar. Yeah. And
John, if you had buying power right now, not represented in any way, you could put it into anything. How would you play? What would you do with $1 million right now today? How would you $1 million in buying power?
Well, I'm not an investment advisor.
Good.
I'll tell you that up front. But I would look to put the. I think the best bet you have for your assets long term is to hold them in gold or silver. Over time, they'll protect the purchasing power of your assets. It's done so for thousands of years. I did an assessment of inflation since 1900 up to date, both the way the government reports it and the way I report it. If you look at the gold prices against the headline inflation, you see it starts soaring about in the 80s, 90s above the inflation rate. But if you use my inflation, which is the way inflation used to be calculated and the way that most people experience it, you'll find that actual inflation has moved higher along with the gold. Gold stays on top of inflation, so that with that over time, and you'll have a lot of variability over time. But if you hold it, it'll preserve the long-term purchasing power of your assets and your wealth, your income.
Yeah, the Committee for a Responsible Federal Budget has recently called on Fox News, or has advocated over Fox News, for the U.S. government to do a soft default on its deficit and to back the dollar with gold and revalue gold to over $10,000 an ounce and use that as an instrument to pay off the debt. What are your thoughts about that as a possible solution?
Well, it's. I mean, I guess they can do that, but you get gold up to $10,000, and you held your if you held your assets in gold, you'd be profiting along with that. Obviously, it is. If that's the case, you've effectively devalued the dollar by 80% or.
Mm-hmm. Mm-hmm.
Or such.
In 1933, when that happened, what was the devaluation of the dollar when the government confiscated gold?
They changed the value in terms of the dollar. They just didn't let people own gold in the United States.
Mm-hmm.
You couldn't own physical gold.
Mm-hmm. So the theft would only be from taking the gold and then having the gold move from 20 to 35 an ounce once it was in the government's hands. So that would be the only loss, is that the gains we would have. Well,
that was a devaluation. That was a devaluation of the dollar against the rest of the world.
Mm-hmm.
It'd be very difficult, I think, to ban private ownership of gold again.
What do you think of Donald Trump, John?
What do I think of Donald Trump?
Yes, sir.
I think he's a good guy. He's had a very difficult time. He surprised the pundits when he was elected, and the reason he got elected, as I see it, was that the average guy didn't believe the government's numbers. Again, this is what I see. The real world, the average person has a pretty good sense of what's going on. The economy's booming along. We've seen this before with the headline numbers, but then you have a change in government because the average guy's not making ends meet. That's what was happening at that time, and I think it was he had recognized the issue. He talked about it. He's done some stuff to change it, but he's had a lot of things blocked in Congress. It's been a very difficult
the
time
stock
for him.
market.
I don't believe the current numbers.
Yeah, the stock market's up 40% since Trump's been elected. How do you explain that?
I'm sorry?
The stock market, it's up almost 40% since Donald Trump was elected president. How do you?
Yeah, that's true.
How do you explain that?
Well, I've never seen the stock market as a long-term, stable and safe investment. It is. I mean, you have a lot of games that are played with the stock market and Wall Street and the financial community. If you put your money, you go back to the year 2000. You put your money in the S&P 500 and you look at their total return index, or you reinvest the dividends, and you put it in gold, you'd be ahead. Be ahead by having put your money into gold.
Could you say that again, John?
Just starting back in 2000,
right? Okay.
It was 2013 before the S&P got above zero net of inflation, where gold just kept going higher. I mean, it's up. The difference is narrowed, but gold is still ahead of stocks. Stocks are a traditional hedge against inflation as well. Tend to be a little more volatile and certainly much more heavily manipulated.
So it's buybacks and inflation. Buybacks, the stock buybacks, the Fed, the low interest rates, the loans to the companies to buy their stocks back, fatten it up.
Yep.
My understanding is that there was a compensation change with regards to the chief executives of companies, that they got compensated on quarterly stock values as opposed to yearly earnings to incentivize their taking these loans from the Fed. Would that be accurate?
I'm sure that's been a factor.
Mm-hmm.
I haven't done any surveying on that myself, but that makes sense.
John, you mentioned GDP is one of the indicators that you track, and it's recently been said that within a few short years we will be at 100% of GDP to government debt. What's your estimation? Are we already there, or is that still looming in the not too distant future?
Oh, we're well beyond it. If you look at total federal, look at Treasury bonds, and that's the debt issued by the government. You're at least a couple of percentage points higher than the headline GDP.
Wasn't the 2-month Treasury?
I'm sorry?
Wasn't the 2-month Treasury yielding more than the 10-year Treasury just last week?
Well, that's an inverted yield curve, which tends to signal that the markets are looking for a recession. And I'll contend that the economy never really fully recovered for most people, and that indeed we're heading into a new recession. The way they define the economic cycle, you have a peak in the economy, then it starts to fall down. That's the recession. Then you hit a trough, self-defined. Then it starts to recover, moving higher. And when it reaches the level of its the pre-recession peak, then it's considered fully recovered. And then beyond that, you have what's known as economic expansion. The headline GDP went through its worst crash since the Great Depression, starting at the end of 2007, troughed in 2009. Actually recovered in 2011. Right now, it's about 25% ahead. It's expanded by 25% from its pre-recession high. The problem is no other economic series has come close to that. If you look at industrial production, it's up maybe 4 or 5% off its pre-recession high. But the manufacturing sector, and the reason the industrial production's up is because of increased oil production. That's been a positive element in the economy. But if you look at manufacturing, manufacturing is still 5% below its pre-recession peak. It's never recovered. It's been a period of non-economic expansion of now more than 10 years. Nothing like that ever before in the history of the series, which goes back a full century. Wow. The housing market has never recovered. The construction's never recovered. And again, on Main Street USA has never fully recovered. That's why Trump got elected. It'll be interesting re-election here because you do have the economy heading lower again, and you can thank the Fed for higher interest rates. But part of the problem as well is that we still never fully recovered. And the stimulative stuff that was supposedly being put into place never it all got sidetracked by Wall Street.
You know, when Trump was running as president, John, he was very clear. He said this is the worst revival since the Great Depression. The minute you raise interest rates, bad things are going to happen. When Obama goes off and plays golf, you watch and they raise rates, things are going to happen. Now the Fed raised rates. They raised them since Trump was elected, what, about two and a half points, right, since he was elected?
Well, they started raising rates earlier in 17.
Okay.
And yes, this is basically since he was elected. At the end of last year, end of 2017, it was one of the third quarter they didn't raise rates, but the fourth quarter and every quarter since then they jacked the Fed funds up by a quarter point. At that, back in the fourth quarter of 2017, the Fed funds rate was 1.25%. Fourth quarter of 2018, they jacked it up to 2.5%, doubled interest rates. Now, they may say, well, that's a small number, but you have to consider that the economy has had virtually no federal funds rate for a long period of time. Then it started coming higher again. The markets, the economy, whatever it is, got used to the low rates, and so you've doubled rates in the last year, and that put an intensified liquidity squeeze on the consumer, and we're seeing it in a number of numbers. I think you're going to see a contraction in the GDP in the next quarter or so, that we're likely in a new recession, although we never really came out of the Great Recession. And I think the Fed's got to ease again, but the government's got to do something beyond that. It's got to.
What do you think that would be,
John? Got to give tax cuts to the average guy and work to stimulate the economy.
Well, John, let me ask you this: we tried corporate tax cuts. That didn't go very far. But what do you see as a government solution? We're not hearing much talk of solutions to fix the debt problem, and clearly that's going to come home, and that's going to be as we may see, potentially one of our biggest upsets to the overall economic growth. What do you see as a possible solution to bring down the GDP?
Well, it's not politically popular, but there's no way out of this. It's going to be a politically happy circumstance for the Congress and the president. You got to bite the bullet. If I were doing it, you're going to need stimulus. You're going to need tax cuts now to really get the economy going again. In addition to the Fed cutting back on its tightening and rate hikes, but because that damages the deficit, you have, and that would also kill the dollar and create some of the other problems I'm talking about. At the same time, what has to be done coincident with it is the administration's got to come up, and the Congress put aside all the bickering and come up with a package, a credible package for long-term balancing of the budget, bringing the deficit under control. You need to widen it now to help the economy and get things back on track. And if you can sell the people who would otherwise dump the dollar that, the U.S. is finally addressing its long-term solvency issues, then you can get by with a stimulus. But if you don't have a stimulus, right, you're going to really scare the markets about the budget deficit. It's
John,
moving out of control.
So the way this is, it's very interesting because what you just said, they have to stop unloading their balance sheet. They've got to lower the interest rates. They have to stimulate the economy. But to do so, they can't kill the dollar, and they've still got to sell the debt in order to do all this. So they have to do a sales job on the buyers of the debt that this is only going to be a temporary problem, that this is what we need. We need them to keep buying the Treasury market because we can recreate our consumerism. We can get this going. Now, in order to do that, though, we have to have a United States of America. And my question to you, sir, do you think this government that we have in place and especially entering a presidential election where there's a lot of grandstanding, there's a lot of misrepresentation, there's a ton of finger pointing. Literally, the two chapters of our government, the president and the Speaker of the House, are calling each other deranged. Do you see this as working out?
I don't think it's going to happen. Not in the immediate future, but where some in different times it might have. You might have been able to rally people around the good cause, and have a talk to the American people. Say, look, we got to do this. We're going to have a happy future for our children and grandchildren. Lay the whole thing out. Unfortunately, to actually trigger that, to get that, get things moving in that direction, you probably need a crisis. Probably need some kind of a panic, and in response to the crisis, then you might be able to get the politicians rallying around something. But a crisis here is not going to be a happy circumstance financially.
Do you think that crisis, John? Do you think that crisis could come in the form of a market collapse?
It could.
That would make the most sense, wouldn't it? I mean, that's
yep.
Yeah. Okay, because
that's something like that. It would have to. I'm looking. It'd be some kind of a financial crisis.
Do you see that on the horizon? Do you see it on the near horizon, John? Based on your statistics,
it could be. These types of things don't come with a great deal of predictability, but everything's in place for it. You need some kind of a trigger sometimes. There are any number of things that could happen here.
John,
you get a financial.
You're a valuable asset, to the American people, and if I'm going to throw a little money, to make sure that you have an armed guard around to preserve your ability to tell the American people the truth. This is so, I can't believe that, this truly, I'm outraged. Most American people, if you were to ask them, when I say, have you been on Shadow Stats? Have you seen what this unemployment number really is? What'd you say, John? What was the unemployment number, the real number again?
It's up around 20%.
Okay. This is 1 in 5 of every American's out of a job. And when I tell the American people that, they can't believe that. They believe it because they see it on the street. But all of a sudden, they realize what a big, fat liar the government is with these figures. And then they begin to wonder, why is the government lying to us like that,
John, just once again, what is your number on inflation? We hear that inflation's hovering somewhere around 2 to 3%. What is your real number on? What do you see it at?
It's up around 10%.
Wow.
And let me just give you a minute explaining what happened there. The government, even starting in the 80s, they want to keep the budget deficit down as much as possible, at least the headline number. And what they did was they looked at where they're spending money, and my goodness, with inflation, the more inflation went up, the more they had to pay out in Social Security and government pensions.
Wow.
So they decided, what we're going to do is, back in the 80s, they didn't discuss too much why they were doing it at the time, although there were people who knew exactly what they were doing. But if they could bring down the inflation rate, that would reduce the cost of living payments that the government had to pay out. Big money. So the first thing they did was they changed the way they measured housing costs. That's a big element of the CPI. Back in the early 80s, it included something as ridiculous as the cost of buying a new home. That was part of it. And if the prices were going up in real estate, that was part of the inflation. So what they did was they dropped that component and put in what they called the homeowner's equivalent rent. What they did was they tried to figure, and then with estimates, completely bogus number, but what they put in was their estimate of what a homeowner would charge himself to rent his own house. And then they calculated the inflation element on that from how much the homeowner would raise the rent on himself each month to rent his own house. And that knocked, they estimated something like 1.5 percentage points off the annual inflation rate. And that's cumulative over time. Coming into the 90s, this is during the Clinton administration, but you had Newt Gingrich in Congress and you had Alan Greenspan at the Fed, were very vocal in favor of changing the CPI. They said it's wrong. CPI is wrong. It's been calculated literally that we've had inflation indices for a couple of centuries, and is always measured in terms of the cost of maintaining a constant standard of living. You want to know what the cost of your package of goods has gone up, because if your income's at least keeping up with that, then you're holding even. If you're not, you're losing ground, and if you're going above it, you're gaining ground. And the way they would measure it, they'd take let's say a price of a gallon of gas, a pound of beef, a loaf of bread. That would be, let's say, the basket of goods. They'd measure it this year, then they'd measure it the next year. Now, however much that price had changed, that was your rate of inflation. Maintaining a constant standard of living. That was what you did for your living. Then what Greenspan would argue is, well, it's price of steak goes up, people are going to buy more chicken or more hamburger, and if they do that, then really they're not spending as much money. And although that may be true, that's not maintaining a constant standard of living. If I've got to eat hamburger because I can't afford to buy steak, I'm not maintaining a constant standard of living. But that's what he argued. And they changed the calculation of the CPI very specifically to reduce the cost of the entitlement payments, as they call them, the Social Security payments that people have paid their money into.
Yeah.
The
military,
the federal pensions.
Yeah, the military, they get inflation adjustment increases that are completely
And
bogus
wherever,
numbers, so they're getting ripped off.
Yep. So that reduced their outlays, and then they also have a formulation for working out the tax bracket that you're in, and because it's the tax brackets get adjusted by inflation as well. So but this enabled them to boost more people into higher tax brackets.
So, John,
I kid you not, and that's all in effect, and it was all discussed before the public. They're very, very open about
How
it.
corrupt!
But it's so that's what all I do is I go back and I add in all the changes I've made as the way it would have been. And if you go back to 1980, you're up around 10% inflation. If you take the changes made just since 1990, you're up around 7%. So it's and when I talk to the average person, who do a lot of talking with people, I don't conduct formal surveys, but the average person will tell me, I think my inflation's probably 4 or 5% above what the government's reporting. So I published two indices, one since wage changed since 1990 and one that's wage changed since 1980. Point is, it's a significant difference.
How is theft of buying power, aka inflation? How is that not plain theft, John?
Well, that's a very dangerous thing, because what they did here from the standpoint of the government gimmick to try and not have to pay out as much as they wanted or to boost their taxes a little bit, that's one thing. But guess what? Most people trust the government's CPI. I've seen landlords tie rents to it. A lot of businesses would raise people's salaries tied to the CPI. And so all these people are not getting the money they think they're getting in terms of purchasing power. So that's a big issue. Then you have, yes, bonds tend to trade above inflation. People are not getting a fair return on their money. They have these inflation-adjusted treasuries. That's based on the CPI.
Yeah, the inflation-adjusted treasuries. That's an interesting one because and they're being adjusted on fake numbers. So they're being held down too. So there really is no inflation protection in an inflation-protected bond then.
Absolutely not. They're worse than the old bonds because there may be a little bit of market appreciation for what's really going on there. It's a rigged market from that standpoint.
John, I can't tell you how much we've enjoyed having you on here today. We'd like to revisit at some point down the road, and maybe we can see some of how some of this has progressed. But again, the website is shadowstatistics.com.
No, that's
short
shadowstats.com.
Well,
Shadowstats.com.
Shadow Stats, but it's short for Shadow Statistics. So you can realize it, shorten it down to stats. And again, John, I've loved having you on. We've all enjoyed it. On behalf of the American Confidant, well, I just got to say, God bless you, John. You know, you're a good voice of truth and a whole mishmagosh of laugh track, and we really appreciate it. Thank you, sir.
Well, thank you so much for your kind comments, and again, thank you for having me on your show.
Believe me, it's been our pleasure.
Thank
Bye-bye,
you, sir.